What if the shortage you're preparing for is actually being caused by the solution? Australia just ramped silver production by 10%. South 32's mines are streaming metal faster than any quarter in 5 years. The ASX Precious Metals Index up 38% year-to-date. On paper, more supply should calm markets, should stabilize prices, should make silver easier to get. Instead, premiums are spiking. Indian dealers are rationing inventory, and China just exported 660 tons in October alone, the largest single-month export in modern records. Something is broken. The math doesn't work. Production goes up, exports go up, but availability goes down. That's not economics. That's warning sign. By the end of this breakdown, you'll understand exactly what's happening in the global silver market right now, why Australia's production surge is accelerating the crisis instead of solving it, and what the 1974 palladium shortage teaches us about what happens when industrial nations weaponize commodity flows. Let me show you what nobody's connecting. 3 data points. When you see them together, the picture becomes clear. Data point 1. South 32's Cannington mine in Queensland increased output by 10% this quarter. Cannington produces roughly 8% of global mined silver. That's significant volume. BHP's Olympic Dam added capacity. Evolution Mining's silver byproduct from gold operations up 12% year-over-year. Australia is the 4th largest silver producer on Earth. When Australian production jumps 10%, global supply should increase by nearly 3%. That should matter. Data point 2. China exported 660 tons of silver in October. For context, China's average monthly export over the past decade was 180 tons. October's number is 3.6 times the historical average. In 1 month, China pushed more silver into global markets than some countries produce in a year. This is the same China that spent the last 3 years restricting precious metal exports, raising classifications, limiting citizen purchases. Now, suddenly, they're flooding the market. Data point 3. India is experiencing physical shortages. Dealers in Mumbai, Delhi, Ahmedabad reporting inventory constraints. Premiums over spot reaching 12 to 15%. Import demand spiking. India is the world's 2nd largest silver consumer. When India can't get silver, that's not a local problem. That's a structural problem. Now connect them. Australia produces more. China exports more. India can't get enough. How does that make sense? It doesn't. Unless the silver isn't actually moving to where demand exists. Unless it's being redirected, stockpiled, held, weaponized. Let me take you back to 1974. Most people have never heard this story. Palladium. Russia controlled 65% of global supply. The Soviet Union was the dominant producer. Western industries, car manufacturers, electronics makers, dental suppliers, all dependent on Russian palladium. Then something strange happened. Russian shipments slowed. Not stopped, just delayed. A week here, 2 weeks there. Technical issues, paperwork problems, shipping logistics. Always an excuse, never a full halt. Western buyers got nervous. They started ordering more to build buffer inventory. Russia kept delaying. Prices started rising. Buyers ordered even more. Russia delayed further. By the time people realized what was happening, palladium had spiked from $150 per ounce to over $400. The delays weren't accidents. They were strategy. Russia was manipulating flow to drive prices while simultaneously stockpiling for their own industrial needs and geopolitical leverage. The people who understood this early, the ones who secured physical palladium when it was still available, they survived. The ones who waited for prices to stabilize, who trusted the system would correct, they got crushed. Some operations shut down. Some switched to more expensive alternatives. All of them learned that commodity flows are never just about supply and demand. They're about power. That same pattern is unfolding right now with silver. But it's more complex because silver isn't controlled by one nation. It's a three-way tension between production centers, manufacturing hubs, and financial demand. And all three are pulling in different directions simultaneously. Australia's production increase isn't going where you think. When South 32 ramps output, that silver doesn't magically appear in American dealer inventories. It goes to refiners. Refiners process it. Then it enters global supply chains based on contracts, relationships, and strategic priorities. Chinese refiners process Australian concentrate. Japanese refiners handle Australian doré. Singapore trading hubs distribute refined metal. By the time Australian silver becomes available to retail buyers or small industrial users, it's passed through 4 or 5 checkpoints. Each one creates an opportunity for diversion. Here's what's actually happening. China is buying Australian production, refining it, then exporting refined silver at a markup while simultaneously restricting domestic access. Why? Because China's industrial demand is exploding. Solar panel manufacturing up 18% year over year, electric vehicle production up 22%, 5G infrastructure build-out continuing. China needs silver for its own economy. But China also needs foreign currency and geopolitical leverage, so they play both sides. Buy cheap concentrate from Australia, refine it, export some at higher prices to earn dollars and euros, stockpile the rest for domestic use. Control the flow, control the price, control the leverage. This is why Indian dealers can't get inventory even though Chinese exports are surging. The exported silver isn't going to India, it's going to financial hubs, London, Zurich, New York, into ETF vaults, into bank reserves, into investment demand, not into manufacturing supply chains where India needs it. Let me give you the numbers that prove this. COMEX registered silver, the stuff actually available for delivery, dropped from 80 million ounces in October 2024 to 43 million ounces by December. That's a 46% decline in 2 months. During the same period, Australian production ramped up and Chinese exports hit records. The silver is being produced. The silver is being exported. But it's not going into deliverable supply. It's being locked into financial instruments and strategic reserves. The ASX Precious Metals Index up 38% year-to-date. That's not just silver. That's gold, platinum, palladium, all the monetary metals. When an entire sector moves together like that, it's not about individual commodity fundamentals. It's about currency concerns. It's about monetary system stress. Investors fleeing paper into hard assets. And when investors compete with industrial users for the same limited supply, industrial users lose. Always. India's shortage is the canary in the coal mine. India doesn't use silver for investment primarily. They use it for manufacturing, electronics, solar panels, jewelry, industrial applications. These are businesses that need physical metal to operate. They can't function on paper promises. When they can't source material, production slows. Orders get delayed. Costs spike. This creates a feedback loop. Manufacturers panic buy to secure inventory. That drives premiums higher. Higher premiums attract more investment demand because it signals physical tightness. Investment demand further drains available supply. The shortage feeds itself. Australia can increase production by 10%, 20%, even 30%. It won't matter if the metal never reaches end users. This is the fundamental flaw in how people analyze commodity markets. They look at production numbers and assume supply. But supply isn't about how much you mine, it's about how much reaches the people who need it. And right now, that flow is being interrupted deliberately. Let me show you something most people missed. In September, Australia's government announced new strategic mineral partnerships with Japan and South Korea. Silver wasn't listed as a strategic mineral. That's intentional. By not classifying silver as strategic, Australia maintains flexibility to sell to whoever pays most. No export restrictions, no government oversight on where it goes. Free market. Except there's no such thing as a free market in commodities during a supply crisis. There's only whoever has the most leverage. China has leverage because they control refining. Japan has leverage because they control technology manufacturing that requires silver. Europe has leverage because they control banking and ETF infrastructure. America has leverage because the dollar still dominates commodity trading. Australia has production but limited leverage because they don't control what happens after the metal leaves their ports. This is why the 1970s and 80s saw resource nationalism. Countries realized that exporting raw materials meant exporting wealth and power. Some nationalized mines. Some imposed export controls. Some formed cartels. The resource wars weren't fought with weapons. They were fought with export licenses and strategic stockpiles. We're watching the early stages of that same dynamic return. Here's the data point that should terrify anyone paying attention. Global silver mine production peaked in 2016 at 890 million ounces. Every year since, production declined or stayed flat. 2024 production estimated at 820 million ounces. That's 70 million ounces less than the peak. Meanwhile, industrial demand grew from 480 million ounces in 2016 to 630 million ounces in 24. Investment demand added another 200 million ounces. The math is simple. We're consuming more than we produce every single year for 8 consecutive years. Australia, ramping production by 10%, adds roughly 5 million ounces annually. That's significant. But it doesn't close a 150 million ounce deficit. It barely makes a dent. And if that 5 million ounces gets diverted into financial vaults instead of industrial supply chains, it helps no one except whoever controls those vaults. The volatility everyone's seeing, the price swings, the premium spikes, the shortage reports, none of this is random. It's all symptoms of the same underlying reality. Physical silver is being separated from paper silver. The financial system created infinite paper claims on limited physical metal. For decades, that worked because most claims never converted to physical. Now, they are. And the system can't handle it. Remember Bretton Woods, 1944. Allies agreed the dollar would be backed by gold, other currencies backed by dollars. Worked perfectly. Until it didn't. Countries started demanding gold for their dollars. America didn't have enough gold. Nixon closed the gold window in '71. Overnight, the system changed. Gold went from $35 to $850. Silver went from $140 to $49. Not because the metals changed, because the monetary system's lie got exposed. We're watching the same pattern with industrial silver. The system promised infinite availability. ETFs promised you could convert paper to physical anytime. Futures markets promised delivery. It was a lie. A useful lie while it lasted, but lies break when tested. And this lie is being tested right now. Australia's production ramp isn't solving the crisis. It's highlighting how broken the system already is. More supply should mean lower prices and easier access. Instead, we're seeing higher premiums and tighter availability. That tells you supply isn't the real problem. Distribution is. Control is. Power is. China's massive October exports, 660 tons, that wasn't generosity. That was strategy. Flood the financial markets to suppress paper prices while stockpiling physical for domestic needs. Make silver look abundant on paper while it becomes scarce in reality. profit from the spread, secure strategic resources, undermine competitors. It's brilliant. And it's working. India's shortage is proof. The world's second-largest consumer can't get metal even during record export months. That impossibility reveals the truth. The silver market isn't one market, it's two: financial silver and physical silver. And they're diverging fast. Ask yourself this question. If Australia increased production and China increased exports, why are premiums rising? Why are dealers reporting shortages? Why is registered COMEX inventory collapsing? The answer is simple. The metal isn't going where demand exists. It's going where power exists. And power right now is concentrating silver in hands that understand what's coming. This isn't about price predictions. This is about recognizing patterns. The Palladium squeeze of 74, the Hunt brothers' silver manipulation of 80, the Nixon shock of 71. Same pattern, different decade. Commodity flows get weaponized. Paper promises get exposed. Physical holders win. Everyone else learns expensive lessons. We're in the middle stage right now, production ramping, exports surging, but availability declining, premiums rising. This is the squeeze phase. The break phase comes next. That's when paper markets freeze, delivery failures cascade, premiums go vertical, physical becomes unavailable at any price. And people realize, too late, that owning something beats owning a promise of something. The clock is running. Not because I say so, because the math says so, because COMEX vaults say so, because Indian dealers say so, because Chinese export patterns say so. The data is screaming. You just have to listen. So here's what you need to understand. Australia ramping production by 10% is significant, but it changes nothing about the fundamental deficit. It changes nothing about industrial demand growth. It changes nothing about 8 years of consuming more than we produce. And most importantly, it changes nothing about where that silver actually goes. The volatility isn't a bug, it's a feature. This is what markets look like when they're breaking, when the paper system collides with physical reality, when decades of promises meet the moment of delivery. History shows us what happens next. The question is whether you're paying attention. The pattern is clear. The data confirms it. The only question left is what you do with this information. Not what you should do, not what I'm telling you to do, what you recognize as true, and what you decide matters. If this analysis made sense, if you see what's happening beneath the surface, subscribe now and drop a comment below. Tell me what you're seeing in your area. Are dealers in your city showing shortages? Are premiums climbing? Are wait times extending? The more data points we collect, the clearer the picture becomes. This isn't just about silver. This is about understanding how power moves through commodity markets when systems start breaking. Subscribe, comment, share this with someone who needs to see it. Because pattern recognition is the difference between being caught off guard and being prepared. The information is here. What you do with it is up to you.